Stock chart patterns are like the language of the market, and learning them helps small investors and traders understand when prices might arise, fall, or reverse. And throughout history, traders have relied on these patterns to spot opportunities. From the early technical analysts in the 19th century who first drew price charts by hand to modern, AI-driven trading systems that still use the same shapes, because while markets change, human behavior often repeats itself, and this repetition shows up in patterns, and the most common are divided into two groups: continuation patterns that signal the price is likely to keep moving in the same direction, and reversal patterns that show a possible change. So let's go through some key ones. First is the head and shoulders pattern, which is one of the most famous reversal signals, where the price rises to a peak, falls, rises to a higher peak, falls again, and then rises to a lower peak before dropping. And when this forms, traders often expect a downward move. The opposite version is called an inverse head and shoulders, which usually signals a shift from falling prices to rising prices. Second are double tops and double bottoms, where a double top forms when the price hits the same high point twice but cannot break through, often leading to a drop, and a double bottom is when the price hits the same low twice and bounces back up, often leading to a rise. Third are triangles, which are continuation patterns and come in three types. Ascending triangles where higher lows push the price against a flat ceiling until it often breaks upward. Descending triangles where lower highs press against a flat floor until the price breaks downward. And symmetrical triangles where the price squeezes tighter until it breaks out in either direction. Fourth are flags and pennants, which appear after a strong price movement, usually a sharp rise or fall, followed by a small pause shaped like a flag or tiny triangle, and then the price often continues in the same direction. Fifth is the cup and handle pattern, which looks like a teacup on the chart, with a rounded bottom followed by a smaller dip forming the handle. And when the price breaks out from the handle, it is often a signal of a strong upward move. Sixth are wedges. Rising wedges often signal bearish reversals where prices go up, but with smaller steps before falling, while falling wedges can signal bullish reversals where prices go down but slowly before turning up. And seventh are gaps, where the price jumps up or down between trading sessions, leaving a blank space on the chart. And these gaps can show strong demand, news, or panic selling. And many traders watch closely because gaps often fill, meaning the price comes back to cover that space. And these patterns are not magic but tools. And when combined with other signals like volume, moving averages, or support and resistance, they become much stronger, and history shows this works. For example, during the dot-com bubble in the late 1990s, head and shoulders patterns on tech stocks gave early warnings before sharp declines, while in the recovery after 2008, cup and handle shapes helped investors spot strong upward runs. And according to Investopedia surveys, more than 60% of active traders use chart patterns as part of their strategy, proving their importance. But remember, no pattern is 100% certain. They only suggest probabilities, and risk management is always key. So the lesson is that by mastering stock chart patterns like head and shoulders, double tops, triangles, flags, cup and handle, wedges, and gaps, small investors can better read the story of the market, spot trends early, and make decisions with more confidence, turning confusing lines into useful signals.